Hi, everyone. Thanks so much for joining us today. We appreciate you taking time out of your busy schedule. I'm going to hand it over to our presenters today, Laura and Lauren, to talk about multi-state payroll.
So my name is Laura Gage. I am the tax specification compliance manager. I've been with Greenshades for over 10 years. Prior to that, I was finance director in public housing for over 30 years. As if I couldn't get enough to do with taxes on weekends, I do individual income taxes.
Awesome. So Laura's on today as our tax specialist. She will cover all the nitty-gritty of this presentation. My name is Lauren. I am the content marketing manager here at Greenshades. So I help put together this presentation for you all today. With that, we'll dive right in. Today, obviously, we're going to talk about the complexities that come with multi-state payroll operations. Tax rates, leave laws, and other regulations vary depending on location. And so that means what works in one state doesn't always work in the other. And so it's challenging to keep up with all that information. So what we're going to cover today is how all those states, all those rules, and that risk, how you can manage that within your payroll system and make sure your company keeps moving forward. All right, so we're going to explore 4 main challenges of multi-state payroll. For each challenge that we present, we're going to present a connection key, basically just a simple strategy to hopefully solve for that piece of the puzzle in your business. So with that, I'll kick it over to Laura.
All right, so puzzle piece 1. We're diving into the diverse landscape. Tax withholding is at the state level, the federal level, at city level, county levels, all over the place. And I'm sure you're all well aware of that. So you're aware that each state has different tax rates, different methods of withholding, different rules to implement the programs. Cities, sometimes within those states, there are cities and counties within cities, within counties, within the state, and all 3 levels tax. You have to be aware of that. The employee information, especially their address, the worksite address and their home address, is paramount that it's accurate. We'll be discussing reciprocity agreements and how that affects the whole process. And the newest piece since COVID, remote work. So your remote worker is going to trigger a whole nother set of rules. So the key piece on this, the connection key, is keep your employee's worksite address and home address accurate. That employee's got to be reminded to update their address. So moving on to puzzle piece 2, this one is tracking time across the states. So especially in staffing agencies, you have, or if you have a lot of people working remotely, you may have employees who work in multiple states, multiple local jurisdictions, and you need to know which jurisdiction that those taxes are supposed to be withheld. So one of the key pieces is overtime rules. So federal government, the basic rule is if they work over 40 hours within your payroll period that you've established, time and a half is supposed to be paid. So the difference here then is if that employee is working in multiple places, determining that regular rate of pay to calculate the correct overtime rate. So the there's thresholds that are various, if they're working in 2 different states or 2 different cities or multiple combinations, you have to know what the minimum wages are in those specific jurisdictions. Are you meeting the maximum amount? When an employee works in the multiple districts, you have to make sure that you're meeting or exceeding those mandates. Some states say, okay, you have to pay your employee to take rest breaks. Other states say that's okay, they can clock out. You need to know where they're working, what rates that are being applicable, especially minimum wages. And we do have a tool that we offer, a geocode tool, but a lot of the local sites also offer geolocation. They'll tell you, if you put in the address, they'll say this is in my jurisdiction, this is not in my jurisdiction. So Pennsylvania does that, Ohio does that, a number of Michigan states or cities do that. So, you you need to be familiar with the jurisdictions your employees are working in, living in. So the key takeaway on that is using your tracking tools with the geolocation or location tagging. So moving on to the third piece, this one is zip code specific labor laws. So some states, the one that pops out to me when I see this is Oregon. So Oregon has a minimum wage that they've established that is well over the federal minimum wage. Within Oregon is Portland. Portland Metro, based upon zip codes, the metro section has one minimum wage. And then Portland non-metro, matching another set of zip codes, is another minimum wage. So you need to, those exemption forms that you're recording, the state level or the city level, the W-4 form is got to be completed correctly, especially those zip codes. It can a wrong zip code can reject a new hire report. So there's over 30 states that have a minimum wage that's greater than the federal. Some states don't even have a minimum wage. And then within those states, there are over 60 cities or counties that have a minimum wage that exceeds the federal minimum wage. And as I mentioned before, you have to provide to the employee the rate that it most benefits them. So if you, especially California, so they have a good number of cities that have rates. And then just recently, the state increased their minimum wage, which exceeded several of the cities. So now you're having to make sure that you have either, the state or the city, whichever is the highest for those employees. And that can affect the paid sick leave because there's a lot of jurisdictions, local jurisdictions that have implemented paid sick leave along with the state. So which one most benefits those employees? The newest piece that have been ramping up, I think this year we've had at least 3 or 4 more states that have added in the paid family medical leave program. So some of these require the employee to contribute. That's a mandate that they contribute, and others say it's up to the employer to either pay the full amount or charge the employee up to this amount. So you have to be aware of what those rates are and how that program is being implemented. The wage and leave laws don't always change January 1st. There's a lot of states or local jurisdictions, for the most part, that change July 1st, especially in California. Sometimes the minimum wage is established by the type of labor. So California has a special rate for hospitality workers. There's a couple other states that do that also. So the key connection on this slide, this puzzle piece, is you need to be able to automate the wage rate updates, which we do send out a quarterly update on local taxes. And then you also have to make sure that the leave accruals have not been changed or updated. Again, this is, you have to make sure that the employee from the prior side completes that exemption form correctly or that W-4 correctly, so you have the correct locations to implement. Moving on to puzzle piece 4. So this is reporting, filing, and registration. This can get complicated, especially if you have remote employees. So if you have a remote employee working in another state, you are more than likely going to have to, number one, pay that state the unemployment report or contribution. When you have an employment, the SUTA, the unemployment, what marries up to that is paid leave and new hire. So those states that the employee is working in, it's going to definitely meet the unemployment and the paid leave and new hire reporting. Registration for state withholding, sometimes reciprocity kicks in and throws that employee into another state. So you're going to have registration in that other state. Along with these registrations, you're going to have to track filing frequencies, the due dates that meet those filing frequencies, and the forms that are needed to report or remit those withheld taxes. On the last bullet point there, the state-specific new hiring adds another layer. It does. But you here are multi-state employers. Most of you probably, maybe not all, but most choose to do the multi-state new hire report. When you have that multi-state new hire report, whatever state you select to do the multi-state reporting to, that's the format you follow, even though another state that you have employees in may require additional information. It will get rejected because you're reporting it to the state that has that specific file format. So the key connection on this tab is the state-specific filing dates, not just state, but also local. And what forms do you need to implement or report those those tax filings? Set up a payroll calendar, establish a to-do list or a tracking page so that you don't miss your deadlines. We do have some programs, payroll tax service, that we help you implement that. So depending upon what product that you're using, you may already have it set up on your side, or if you're using one of our products, we're helping you make sure that you meet your deadlines. Moving on.
So all in all, those are 4 challenges that make multi-state payroll challenging. But when you connect those pieces that we talked about, hopefully that leads to seamless payroll. And so those are your 4 connection keys to improve your multi-state payroll operations. By implementing those ideas, hopefully your operations run smoother, your reports get filed on time, everything runs smooth. So in this next section, we're going to look at some more specific items, including reciprocity agreements, the management of local taxes, and the idea of tax nexus. So again, I'm going to flip it back to Laura to dive into those.
So the reciprocity agreements are only implemented at the state withholding level. That's it. No local taxes. SUTA does not get affected by this. New hire reporting does not. So what reciprocity agreement is, if one or more states agree that if we have employees working in this state, but they live in another state, in those 2 states, the working site and the home address site where the employee's working, share reciprocity. They say, okay, the employee is living in state New Jersey, but working in PA. So just collect the New Jersey tax, withholding tax. But over on PA side, you're going to be, because that's where they're actually working, you're going to be doing the SUTA. You're going to be doing the paid leave, the new hire reporting, all of those other types of reporting that based upon where the employee works. But the reciprocity will throw that employee tax withholding, state tax withholding, over into their home state. So it's very important that you're aware of what states have reciprocity and which ones don't. And if they're working in more than one state, it says here at the pro tip, you will still need to withhold SUTA and follow labor laws. So there's those 4 rules that have been established that if you're not sure which state the employee should be reported to for SUTA, you follow those 4 rules. Location, which ones are they? So there's location, base of operations, direction and control, and state of residence. So those 4 are the 4 criteria establishing when or where that employee should be reported for SUTA. For reciprocity, the employee's got to complete that W-4, that state level or local level, or actually state level W-4. A lot of them have exemption forms, a variation of an exemption form, or part of that state level W-4 has a part that they complete for home address. That has got to be completed accurately and turned into HR or payroll to implement. Moving on, the local and city taxes. So local taxes can be cities, it can be counties, it can be school districts. There's a whole wide range of them. Now, sometimes you're going to have the county has a tax rate, and then within that county is a city or a municipality that has a tax rate. And sometimes, especially, it gets a little confusing, especially with Kentucky, where sometimes the city and the county both tax, and other times they have gotten together and you report one payroll deduction for that jurisdiction, and then they do the disbursements, however they determined to do that for the local taxes. Some states make it very easy. Pennsylvania, they spit out this whole report with over 2,600 variations of PSD codes. Ohio uses the Finder. You can use that to make the determination of a municipal or municipality tax, school district tax, and they have also factored in JEDs. So trying to navigate where this employee withholding should be withheld for at what rate and where should it be reported to. Some states have their reporting done through the state. That's Maryland and Indiana. So each county within those states implement a local tax, but it's all reported through the state, not to the local district. So moving on, the next one is the Ohio. So Ohio offers a courtesy tax. And when I say courtesy, so this employee is working in Mansfield, Ohio. Local taxes are based on worksite. So that employee, in this example, is making $50,000. Mansfield tax rate right now is 2.25. So that employee is going to owe the city of Mansfield $1,125. But they live in Ashland. Ashland has another tax rate of 2%. What the resident income tax rate credit is, they say, okay, we're going to allow you to use part of what you paid into the worksite city, which in this case is Mansfield, and allow that amount to come off of the amount that you would owe your home city, which would be Ashland. So the tax credit for Ashland is 66.67, or 2/3 of the worksite tax, but they limit it to 1%. So if you take 50,000 times the 2.25 times the 67.67 or 66 point, the 2/3 percent, that comes out to 750. But it's limited by 1%. 1% of 50,000 is 500. So 1,000 minus 500, the credit is what is going to be, they're going to owe to Ashland. You as the employer do not have to do the resident income tax. You do this as a courtesy. It's the same as if you had an employee in two states that do not have reciprocity, and that employee comes to you and says, will you withhold the income tax for me from my home state because I'm going to owe that, and they don't want to owe it all at one time. That is on your level, on your side, a courtesy tax. It's not required, but you can do it. It's allowable. So knowing that you can do this, knowing the formulas, especially for Ohio, if you're going to do it, it's important that you know how to do that. So moving on is the reporting, the filing, the registration. So now we've talked about, if an employee is working in multiple states or multiple local jurisdictions, that you register with each one of those jurisdictions to make sure that you're reporting the wage withheld and the wages and the tax withheld. So you have to register with them. They're going to be expecting you to report. A lot of them will expect a zero wage report, especially like if you're a staffing agency and periodically you have employees in this district, but not every quarter. but you don't want to close the account down because next quarter you may have someone. So if there was no wages to report for that quarter, a lot of them want that 0 wage report. They sometimes just put a check mark on the form to submit to the city or the county. So you can have, like with reciprocity, you can have an employee working in one state. So SUTA, like I said, SUTA, new hire. And if they have the PTO or paid family leave, those would be in the one state. And then with the reciprocity, you're reporting to their home state. So you have to be aware of all those rules. Most states have established remote acts, that if the employee's working remotely, you use that one. There are several states. New York is one of them. That employee works in New York, that employee lives in New York, you're withholding New York taxes. There is no reciprocity with New York. So if that employee is working in New York and living in Connecticut, they're paying both states. And you have to be aware that that's going to happen. So having those employees out there working in a variety of different jurisdictions, different states, you have to be aware of how the nexus is going to create a filing requirement for you. And hopefully that explains everything for you.
Awesome. Thanks, Laura. She is definitely our expert in that and covered a lot today. These are our key takeaways from today's session. 5 things you can take away to improve your multi-state payroll compliance. Assign home and work addresses. Seems simple, but keeping that updated and making sure your employees tell you their home addresses and keeping that on track is super important. Setting alerts for tax and wage law updates. Staying on top of that. Better yet, use a system that updates them proactively for you. Another tip, standardize onboarding by jurisdictions. You're going to have state and local forms and so many other things to take care of. Standardize it, makes it easy. Using timekeeping tools that capture location. We've said it multiple times. Your tax where you work. Make sure you know where they work. And then audit quarterly. This is just a best practice, I feel like, in businesses overall. But if you have a system for checking to make sure everything's running the right way, you can catch those errors before they grow into bigger issues. Here at Greenshades, we support the multi-state payroll puzzle. We are built for that sort of compliance from the ground up. We automate tax codes and rules and assign it based on work locations. We have proactive updates supported by our expert compliance team, which our lovely Laura is part of. And we have self-service, so employees can manage their addresses and their forms online themselves to take a little bit of burden off your HR department. We have a lot of resources on our website for you to refer to if you want some additional information. These 3 items will be included in the recap that we will email you today, tomorrow, or the day after once we get everything up for you to read.
Thank you so much for joining us this afternoon. Again, we know you have a busy schedule. Have a good afternoon, and thanks a lot.